Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points, highlighting key learnings from the market activities from the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll look at ISM Services Data. In point number 3, we'll look at the University of Michigan sentiment and inflation data. And in point number 4, we'll take a look at the FOMC meeting and the results from that meeting. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta Fed GDP Now report shows a healthy 2.5% growth as of November 7th, which is up from the previous estimate of 2.3%. This data incorporates wholesale trade data, which was updated last week. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims data showed a slight increase of 2.3% from last week, ending at 221,000. Continuing claims also rose to 1.892 million. Next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw another slight uptick in the 30 and 15-year mortgage rates, ending at 6.79% and 6.00% respectively. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread rose slightly from 8.58% last week to 13.97% this week. We'll look at sentiment data in more detail in point number 3, but that's more focused on inflation-related data. Next, we will continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 64.6% probability of a 0.5% decrease and a 35.4% probability of a 0.25% decrease in December. Since last week we had the latest FOMC meeting and updates from that FOMC meeting, I wouldn't put too much weight on this data just yet. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and income, but only when considered together, ended positive 4.98%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 8.16%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was negative 0.23%. Another team takes the win this week, aggressive growth. Stocks for the win. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Now, on to point number 2, ISM Services Data. The ISM Services PMI, a key economic indicator, registered a significant increase in October of 2024, reaching 56%, its highest point since July of 2022. This marks the 4th consecutive month of expansion in the services sector and the 8th time this year that the composite index has been in expansion territory. The growth was primarily fueled by a substantial increase in the employment and supplier deliveries index, both of which rose by over 4 percentage points. This positive trend suggests a robust and expanding services sector contributing to the overall growth of the U.S. economy. The expansion of the services sector is further corroborated by the fact that 14 industries reported growth in October compared to 12 in September. The services PMI has expanded in 20 of the last 22 months, indicating a consistent upward trajectory. The report also highlights that the October services PMI corresponds to a 2.3% or 2.3 percentage point increase in real gross domestic product on an annualized basis. This reinforces the positive impact of the services sector on the overall economic performance of the nation. However, certain areas within the services sector showed signs of contraction or slower growth. The business activities and new orders indexes both declined by at least 2 percentage points. This could be attributed to factors such as political uncertainty surrounding the U.S. presidential election, with businesses hesitant to make major decisions until after the results are known. Additionally, the impact of hurricanes and port labor turbulence, while less severe than anticipated, also contributed to the slowdown in certain areas. Despite these challenges, the overall outlook for the services sector remains positive. The employment index registered a significant increase, reaching 53%, its highest level since August of 2023. This indicates a healthy job market within the service sector. Indicates a healthy job market within the services sector, with businesses actively hiring to meet increasing demand. Moreover, the supplier deliveries index remained in expansion territory, indicating a slower delivery performance, which is typical when the economy is improving and customer demand is rising. Overall, in the October 2024 ISM Services PMI report paints an optimistic picture of the U.S. services sector, with continued growth and expansion expected in the coming months. And now on to point number 3, the University of Michigan sentiment data, specifically around inflation. Consumer inflation expectations have exhibited stability in recent years, with notable increases in 2022 followed by a moderation that persisted into 2024. Despite this moderation, long-run inflation expectations remain slightly elevated compared to the pre-pandemic period. Data collected by the University of Michigan between 2017 and 2024 reveals that various features of long-run inflation expectations share a similar pattern. Expectations remained stable in the years leading up to the pandemic, escalated in 2022, and have since eased but have not yet returned to pre-pandemic levels. Median long-run inflation expectations, the preferred measure, have been relatively stable, peaking in mid-2022 and softening thereafter. As of October 2024, median expectations from interviews remained within a narrow range of 2.9 to 3.2%, slightly higher than the 1.9 to 2.8% range observed between January of 2017 and February of 2022. The 75th percentile of responses reflecting higher inflation expectations follows a similar trend, reaching about 10% in 2022 before leveling off to 6% in 2024, which is still higher than the 4% observed pre-pandemic. The share of consumers with extremely high inflation expectations, or 15% or higher, averaged 2% in 2 years prior to the pandemic, surging to 14% in July of 2022, and has since eased to about 11% in 2024. This suggests that a minority of consumers continue to believe that high inflation remains a possibility. The mean, which is not the preferred measure due to its sensitivity to extreme responses, also reflects this trend, closely mirroring the pattern of extremely high responses. Mean expectations have stabilized throughout 2024 and are currently below the 2022 peaks. The interquartile range, which is a measure of dispersion or uncertainty in inflation expectations, widened in 2022 before narrowing and stabilizing in 2024. And now on to point number 4, the FOMC meeting and their results. On November 7th, 2024, the Federal Reserve implemented a 0.25% rate reduction in interest rates, setting the target range for the federal fund rates between 4.5% and 4.75%. This decision, which was widely anticipated by market analysts, was prompted by a softening labor market and a decline in year-over-year inflation rates. The move is expected to bolster equity prices, industrial commodity prices, and bond prices, while potentially exerting downward pressure on the U.S. dollar. Federal Reserve Chair Jerome Powell, during a press conference following the announcement, fielded questions regarding the rationale for the rate cut and the potential timing of future adjustments. Notably, the press conference took place just 2 days after the 2024 U.S. presidential election, leading to Powell deftly navigating a series of political charged inquiries. Looking ahead, the economic projections suggest further rate reductions are likely, with a possible 0.25% decrease in December, following additional cuts throughout 2025 and 2026. This projected trajectory of declining interest rates is viewed as favorable for businesses and consumer confidence, economic activity, and overall market sentiment. The Fed's dual mandate, which focuses on fostering full employment and maintaining price stability played a key role in the decision to cut interest rates. The FOMC statement released on November 7th acknowledged the easing of the labor market conditions, noting that while the unemployment rate hasn't risen, it's remained low. Data from October revealed the unemployment rate of 4.1%, coupled with over 7.4 million job openings in September, indicating a relatively robust labor market. On the inflation front, the FOMC statement recognized that inflation remained, quote-unquote, somewhat elevated. Despite exceeding the Fed's 2% inflation target, all four key year-over-year consumer inflation rates, total CPI, core CPI, total PCE, and core PCE, have been trending downwards. Projections indicate these rates will continue to decline, although the return to 2% target for total CPI or core CPI is not anticipated until 2025. The overarching takeaway is that if inflation continues to moderate, further interest rate cuts are likely to be on the horizon. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to all other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below and schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.